Robinhood filed to IPO on March 23, 2021, and soon it may be a public company that you can invest in. In this video, I'm going to tell you everything you need to know about the Robinhood IPO, when it's going to happen, when you can start investing or shorting, and how Robinhood might stack up against other fintechs as a public company. But first, let's get started by talking about how Robinhood got to where it is today. Robinhood was founded in April 2013 with the goal of using technology to democratize stock trading for the masses. They quickly grew in popularity through savvy marketing, using their sign up and get a free stock deal, as well as by offering commission-free trades. This made it really easy for them to capture new investors, especially those who didn't already have an investment brokerage, like most millennials and now Gen Z. Robinhood showed explosive growth over the next several years, reaching 13 million users by 2020, according to testimony to Congress by the CEO. So about that testimony. Robinhood recently got into hot water with Reddit's Wall Street Bets community while they were evangelizing GameStop stock. Robinhood temporarily froze trading into the stock, causing the community to accuse them of collaborating with short sellers of the company. This whole controversy also put a lot of attention onto Robinhood's practice of payment for order flow, where they would actually sell their users' trades to high-frequency trading firms in exchange for a small commission to make up for the fact that their actual trades were commission-free. Those firms then could potentially use that information to undercut those trades and make a few fractions of a cent off of each individual trade. While that might not make up a huge amount of money on one trade over a long time period, that's a ton of value that they can extract from retail investors for themselves. Just ask Ken Griffin, the richest man in Chicago and also the CEO of Citadel Holdings, which is one of the firms that Robinhood sells the trades to. Now, I should note that Robinhood is not alone in this practice. In fact, pretty much every brokerage out there now offers payment for order flow. But despite this controversy, Robinhood has continued to grow, both in terms of the number of users actually using their trading platform, as well as in terms of the number of features that they offer, expanding into areas such as cash management, offering a debit card, and crypto trading. The company finally publicly announced that they would be IPOing shortly in March 23rd of 2021. But what exactly does that mean? March 23rd, 2021 marked the day that Robinhood publicly announced that they had already filed paperwork with the SEC to IPO as a public company. The paperwork, as well as Robinhood as a company, is going to have to be reviewed by the SEC before they release a final decision on whether or not they're going to allow the stock to go public. While this can be a pretty long process, one source I saw said it takes between 90 and 150 days. With the increased scrutiny on Robinhood, especially with the CEO having to testify before Congress, I wouldn't be surprised if this takes a little bit longer than average. So we don't know exactly when Robinhood submitted their paperwork to the SEC, but I think it's a pretty fair guess that they did this around 90 days before they made the public announcement on March 23rd. That way, potential investors wouldn't be waiting as long for the stock to go public and the hype could stay built up around the company. Plus, this timeline is also supported by a Reuters article that came out in December 2020 about Robinhood being in talks with Goldman Sachs at that time about IPOing. So if we assume that that timeline is true, and 90 days had already elapsed in the SEC's review process before Robinhood even announced that they were going public, that would put the review process ending sometime between now and the end of May, assuming it takes an average amount of time. But even after the approval is granted by the SEC, there's still more work that has to be done before you can actually go out and buy Robinhood shares. When a company IPOs, they usually have to go to a Wall Street bank who will help value the company, determine what the initial price of the stock should be, and then go out and shop the company to private investors to invest pre-IPO. This pre-IPO investing has traditionally been restricted to institutional investors like banks and hedge funds. The issue with this is the final IPO price that a company comes to the public with has traditionally undervalued companies by $37 million, meaning that that's just money that's left on the table. And who gets all that extra value? The big institutional investors who invested in the company pre-IPO. Some companies recently have gotten around this by going public in what's called a SPAC, or a special purpose acquisition company. This is essentially a way for a company to go public while skipping the whole Wall Street bank process and investing with pre-IPO institutional investors, and instead offering retail investors like you and me the opportunity to invest in the company before it actually goes public. SoFi is a recent example of a company that's planning to go public via a SPAC, and I recently made a video on that. But Robinhood isn't doing a SPAC. They're going with a traditional IPO, and they have their own plan to let retail investors invest as close as possible to pre-IPO in the company, all while still following the traditional Wall Street route. Now, while certain apps like like SoFi actually allow you to invest in certain companies pre-IPO before they're actually public, and Robinhood is supposedly working on this same functionality. It's not yet clear if Robinhood's version of that platform will be built in time for the IPO, so Robinhood may or may not actually be available for pre-IPO trading with retail investors. But imagine if it was, that would be great publicity for Robinhood's new platform if you could actually invest in the company on the same platform that they had just built. But worst case, assuming Robinhood does not let you invest in the company pre-IPO, they do have a feature that lets you make trades in companies pre-IPO, and there is a difference. What Robinhood has built right now is the ability to make pre-IPO orders. What that means is you can enter an order into Robinhood's system on the same day that a company is going to go public. For example, let's say a company is going to go public tomorrow at 11 a.m. Well, tomorrow at 8 a.m., you could enter an order into Robinhood's system to buy that stock once it goes public. Now, that order isn't going to go through until the IPO actually finishes, but at least your order will be entered into the system and you don't have to log in manually at 11 a.m. and enter the order yourself. These orders are restricted to limit orders, meaning you have to specify the price that you're willing to buy the stock at. Also, this functionality is only for specific IPOing companies. I guess Robinhood has to manually approve them. And Robinhood has not yet included their own stock in the list of companies that you can invest in using this feature. However, assuming Robinhood doesn't get the full-blown pre-IPO investing platform built by them, I think it's a pretty good bet that you'll at least be able to use this feature on their stock once they go public. But okay, Robinhood's going public and we might be able to buy in sometime this summer. Do we actually want to? When Robinhood goes public, how do we know that the stock price is going to increase substantially over time? Well, it needs to, one, continue to provide a product or a series of products that can beat incoming competitors as well as existing established companies. And two, it needs to be a solid company with good financial fundamentals. So we can start with the second point, since there really isn't too much there to discuss. Unfortunately, with private companies like this, they don't release their financial information, and Robinhood is notoriously tight-lipped about any information around their revenue or their users. It took the CEO having to testify before Congress just to learn that they have 13 million users back in 2020. So that number, 13 million users in May of 2020, likely vastly underestimates the number of users that Robinhood has now, especially with all the publicity that they gained from the whole GameStop incident. While a lot of that news may have been negative, as they say, all press is good press, and one website, thebusinessofapps.com, estimates that Robinhood may have as many as 20 million users today. And while many may make fun of Robinhood for just being an app for broke college students, the average age of investors on the app is actually 31 years old, meaning some are younger, but some are also older than that age. Looking at what little information we have about their financials, back in 2020, Robinhood generated $682 million in revenue by selling their users' trades to high-frequency traders. But we do know that app activity has definitely increased since then. In fact, if we plot Robinhood's revenue increase over the years, it looks something like this, showing that they are growing extremely quickly. While we may not know what the actual number is today, we do know that Robinhood is growing faster than ever, and more than likely their valuation is going to reflect this high growth metric. When Robinhood first met with Goldman Sachs back in 2020, the number that they were throwing out for the company's valuation was $20 billion. But since then, bids for Robinhood in pre-IPO pricing go as high as $40 billion for the company. So at least in the short term, Robinhood's valuation has definitely increased. But once it goes public, can we expect this increase to continue? I think that depends mostly on questions around their products and their competition. Robinhood got an early lead in the mobile investing space by creating innovations around free stock trading, as well as their famous marketing strategy of offering you one free stock when you sign up. This early lead has helped them build up their brand to such a point where even though their competitors offer more attractive sign-up bonuses, for example, WeBull offers you 2 free stocks and M1 Finance offers you $30 when you sign up and deposit $100, Robinhood has still managed to stay ahead. This is even despite the fact that both of these apps have a broader set of investment features than Robinhood, despite being relatively newer apps. Now, it seems likely, at least to me, that Robinhood is going to cut back on their free stock bonus once they go public. This seems like one of those really capital-intensive marketing strategies that work well for a small startup trying to gain traction, but doesn't really scale well once you have, say, 100 million users on the platform. So once that does happen, it'll be interesting to see if Robinhood is able to hold on to their customers, or if those customers are going to be lured away by higher sign-up bonuses at other startups. I think that Robinhood's brand will actually be strong enough to hold on to most of their customers, but when it comes to their products, the story might be a little bit different. In order for Robinhood to exceed as a public company, they're going to need to offer more than just a stock investing platform, and they clearly know this. In 2018, Robinhood launched limited crypto trading. In 2019, they launched their cash management account in partnership with Sutton Bank, and shortly after that, they launched a debit card for their users. In 2021, they may launch an integrated crypto wallet. Robinhood is aggressively moving beyond simple stock investing and into all areas of personal finance, trying to make themselves competitive with other finance companies like Wells Fargo or the Goldman Sachs of the world. And at least in this finance space, I think that Robinhood has a huge advantage over traditional finance companies. I think that there's an inevitable shift toward fintech companies over traditional finance that's going to be happening soon. And while some banks are going to try to survive by partnering with technologies, so think about the Apple credit card, which was made in partnership with Goldman Sachs, I don't know if this is going to be as successful as fintech-native companies. In the same way that I talk about cloud-native companies on this channel and how they're coming to dominate the cloud space, even over entrenched competitors who might have way more funding than them, I think the same thing applies to fintechs. Fintech-native companies that are built from the ground up as technology companies are going to be able to innovate much faster and much more effectively than traditional finance companies that try to bolt on technology after the fact. If we just look to China as an example, Alibaba is sometimes referred to as the Amazon of China. It's a huge e-commerce platform. But in addition to e-commerce, they also own Alipay, which has over 1 billion users and processed over $5.5 trillion in customer transactions. Because China didn't already have an existing finance industry, this can almost act like a case study of what would happen right now if you needed to find the most effective way to offer financing to users. And the winners are clearly fintech companies. So if that's true, Robinhood's real competitors aren't going to be traditional finance companies, they're going to be other fintech companies like WeBull, M1 Finance, and SoFi. Now, I've done reviews on both WeBull and M1 Finance in the past. WeBull has a much more full-featured investing platform, which is really tailored for professional investors or at least more experienced investors, but they don't seem to have the same ambitions of Robinhood of moving into all areas of personal finance. M1 Finance, on the other hand, definitely has more interest in the personal finance space, and they offer a really good product, but they don't have even close to the number of users that Robinhood does. They don't even have 1 million users on their platform as of today. So that leaves SoFi. SoFi is another personal finance company that has ambitions of going public soon, and you can watch my previous video on them if you want a more in-depth review of the company. SoFi offers similar stock trading functionality to Robinhood, though with perhaps slightly fewer features since they are a newer app, but they also offer certain features that Robinhood doesn't, including pre-IPO trading for certain companies, and perhaps more importantly, lending. I think for Robinhood to really become a force in the finance industry, they need to get into lending, mortgage lending, student loan lending, maybe small business loans. Once you have a 30-year mortgage with a company, you are more than likely going to continue to use other services from that company, assuming they're good. It's just so much easier to have all your finances in one place than to use one app for trading, one app for loans, one app for cash management. If Robinhood can actually capture customers into a 30-year loan, those customers have every reason to use the rest of Robinhood's services. And while Robinhood may move into this area in the future, SoFi actually started out as a student loan company, meaning that they've been offering loans all along. Additionally, SoFi recently managed to acquire a bank charter, allowing them to offer cash management without partnering with a real bank. Robinhood actually tried and failed to get the same charter, eventually giving up on the whole process. So once both SoFi and Robinhood are public, it's going to be a race to see who's the real winner. A loan company that has a decent trading platform that just needs to grow their user base, or a really good trading platform that still needs to move into the loan area, but they have a pretty well-established user base. I think it's way too early to call, and to be honest, I think it's going to be several years before either company captures enough market share from traditional finance companies that they really need to compete with each other directly. One potentially untapped market for both companies, however, is international customers. Robinhood recently decided to postpone their expansion into international markets, starting with the UK, to instead focus on improving their core product. SoFi, on the other hand, started expanding internationally back in April 2020, starting with Hong Kong. So you can bet that as I watch Robinhood as a company over the next several years, SoFi is always going to be in the back of my mind. So Robinhood is going to face serious competition down the line, but I think that's a good thing because that's what drives innovation. My hope is that once Robinhood goes public, it will kick off other fintech companies to really start entering the market more aggressively and start to push out traditional finance companies that are both slow and inefficient. If Robinhood is able to make this transition successfully, the company's valuation is going to increase. If not, the company may just stagnate after it goes public, and people will remember Robinhood as that one app where they used to trade meme stocks. But let me know if you would invest in Robinhood. Don't forget to get your free stock down below in the description. After all, they may cancel that once they go public. Don't forget to like and subscribe if you enjoyed the video, and I'll see you next time.